Well, good afternoon, everyone. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute, coming to you from the Palm Springs and greater Coachella Valley area. You might notice I'm wearing kind of a sweater today. Well, guess what? We have a little bit of winter weather out here, which is obviously not that common given we're in the desert. We've had a little bit of sprinkles and so forth, and a lot of wind actually. So, and it's actually kind of chilly as the desert goes. Low 60s is not exactly chilly for those of you who might be in other parts of the country in the Midwest and Northwest and so forth. Anyway, what I want to do now, first of all, is let's get into our usual first step, which is we're going to talk about where mortgage rates are and where the bond market is. Jeff's going to pull up our rate grid from our website. And right on the homepage we have a grid of mortgage rate, what I call indications. These are based on certain parameters, so they would be subject to change based on your particular circumstance, but they give you a pretty good idea of where mortgage rates are, at least those that are offered by us at MortgageWorks. And I've told you more than once that we generally can offer better rates than what you read on online or what you hear on the financial news and so forth. And in fact, we talked about that a little bit last week, and we'll touch on that again today. The good news is rates are hanging in there. I mean, we're, conforming 30-year fixed rate loans are, below 6.5, they're low sixes. FHA, VA are back in the fives. So that's really good. And of course, even jumbo loans are getting into the low sixes. So I think, again, this is an example of how I think the mortgage rate market has sort of stabilized. We've been in these levels now for a pretty extended period of time, and of course, I'll remind you, Fannie Mae is predicting now that at the end of 25 that we'll be at 6.6%. Well, we're better than that right now. So if anybody's looking to get a mortgage, you ought to jump on it, because if we're to believe Fannie Mae, and they're pretty well informed about interest rates, obviously, things could be worse at the end of the year versus where they're at now. So again, if you want to know more about mortgage rates and how they're determined, just click on that link at the bottom of the rate grid, where we have a short video where I go into detail about how these rates are determined. Let's look at the 10-year bond yield chart. I think it's, again, good news generally speaking. We're still in the 420s. Remember, it's only 3 or 4 weeks ago we were 450 plus, in fact, even approaching 460. So things have improved pretty nicely. This is the kind of 5-day chart that we like to see. Of course, you can see a little bit of a dip midweek, not the Wednesday dip that Jeff likes to see happen. It's a Tuesday dip, but still, overall, we've had a bit of a creep up later in the week up to today, but not a lot. We're still in the 420s. That's good news. Of course, that dip on Tuesday, there was a point in time during that trading day that the 10-year bond yield actually got down to 4.15. That's pretty darn low. And of course, the media will tell you, oh, rates have plummeted. We're at the best rates we've been at in a long time. Well, yes and no. I mean, they're certainly better than they were, again, about a month ago. We're still about 5/8, 0.5% higher than we were last September, when the 10-year bond yield, if you recall, was down to 3.6. So we're heading in the right direction. Do I see 3.6 on the horizon? I do not, but I think it's pretty good that we're at these levels. So let me talk a little bit about why we're at these levels. The economic data this week is relatively light. What came out on Monday, for example, the ISM Manufacturing Index, that's the Institute of Supply Management. That number came in a little bit soft. So that certainly helps the bond yields. Unfortunately, a softer economy, a deteriorating economy generally is good for bond yields and therefore mortgage rates. I hate to say that. Then on Wednesday, we had the ISM Services Index. Remember, the services sector of the economy is about 2/3 of the economy. And that was slightly better. In fact, it was fairly brisk. So of course that can have an impact to the negative side in terms of bond yields, because the bond market doesn't want to see a super strong economy, because that suggests that inflation is going to heat up, and of course that inflation is definitely the number one enemy to bond yields and therefore mortgage rates. What's really happening this week, and I've mentioned this before, and it's talked about in again that tab on our rate grid where I talk about how mortgage rates are determined. we're in a period here for the last several days where I think flow of funds is really dominating the markets, in particular the stock market, well, the stock and the bond market. And what I mean by that is all this news, especially early in the week. If you recall, the stock market over 2 days dropped by 1,200 points. And that was as a result of the current administration's tariff policy. It's creating some real nervousness in the markets, in particular the stock market. And that's why we had this huge sell-off early in the week. So as you can see there, I put flow of funds trumps economic data points. And I will admit that pun is intended. And what I mean is that Trump's, the current administration's tariff policy that spooked the stock market. One of the things that can happen when the stock market is spooked is flow of funds. Money gets pulled out of stocks. That's why stocks were down over 2 days, 1,200 points, the Dow Jones I'm talking about. And then money flows into a safe haven. What's the best safe haven in the U.S.? Treasury bonds. So that there's a correlation there. The reason we saw 415 on the 10-year earlier this week was in the midst of that 1,200 point sell-off over 2 days. So money flows out of stocks and gets parked into a safe haven like treasury bonds. So that's really, I think, the dominant situation that's occurring in the financial markets this week, and helping to keep the bond yields lower. Now they've creeped up a little bit, from the 415 low point, but still, if you're under 430, that's a pretty good level. And I think we're going to stay there for probably a good amount of time. What's coming up for the rest of the week is the jobs report. And of course, that's always, a potential market mover. The jobs report, of course, includes how many new jobs were created the previous month, what the unemployment rate is now. So that can have an impact on where we're at. The Trump issue, I should say the Trump tariff issue, is still at play. You can see the stock market's down by several hundred points today. It didn't seem to really bring down the bond yields as much as it did earlier in the week. But all in all, we're talking about a pretty narrow range, 415 to 428. A range of that's that narrow, I think, is overall a pretty good situation. So let's see what happens with the jobs report tomorrow. Keep an eye on that. If you see any indication that there's a bunch more jobs created, or the unemployment rate is the same or better, dropping, that probably is not going to be good for the bond market, and we could see a little bit of uptick in rates. But let's see what happens. Check on that tomorrow, and then we can talk about that next week. So with that, I'm going to go ahead and bring Jeff in, because we've got a few things we're going to discuss about the mortgage market this week. So hi, Jeff.
Hi, Art. How you doing?
Doing all right. How are you?
Good. Hey, I'm in the East Valley. It is windy there as it is here. It's like, I just saw Mrs. McGillicuddy her cow flying down the road here.
Yeah, well, it's not as windy now here on the west side in Palm Springs, but I got to tell you, early this morning, it was like hurricane force. It was crazy, crazy windy. And of course, what happens there is it's that weather that's coming in over the San Jacinto Mountain. It just blows through the valley here, and yeah, we were very, very windy this morning. But in fact, I almost didn't want to jump in my car and come over to the office, because I was too busy trying to get my hair fixed after I went outside and the wind blew my hair all over. So, and of course, that's a joke. Anyway.
Another one of those jokes. Okay. Hey, yeah. I want to do, before we get too far this, I want to follow up a little bit on last week's show about lender paid compensation. You were talking a little bit about, how when one lender pays a mortgage broker like yourself one rate or 1%, and then another, we see the rate goes up, but we didn't get a chance, and it's my fault. I should have asked, what does that do to our payments? I mean, at the end of the day, as somebody wanting to get a loan, that's what we want. What does that do to my payments?
Well, very good question. And yeah, we talked about the rate differential. And for those of you who didn't see what we talked about last week, very quickly, what we discussed is the fact that mortgage brokers, who, by the way, are about 25% of the total mortgage origination market in the U.S. So we're a dominant player in the industry in this country. Mortgage brokers are required to declare what they want a lender to pay them for what's called lender paid comp, and it's a percentage of the loan amount. And typically the range of percentages that we as a broker can request from the lender varies from about 1% up to 2.5%. And what we talked about is how that is a major factor, in fact, probably the most direct factor that affects what kind of rate you're going to get from that broker. And in these days, most loans are originated at 0 points. Borrowers generally don't pay points these days. So we had shown how a broker who only needs or wants a 1% lender paid from their lender, the rate could, with 0 points would be 6 3/8. That was at that time. And actually the rate's, I think, still about that level. And then we also showed that if the lender paid comp's 1.5%, the rate goes up to 6.5. The lender paid comp goes up to 2%, which, by the way, is the average in the industry. On average, mortgage brokers ask for a 2% lender paid comp from their lender. So at a 2% lender paid comp, that rate isn't 6 3/8 or 6.5 for 0 points. It goes to 6 3/4. And then for those outlier brokers who want to make as much money as they can on one loan, who want 2.5% from their lender, that rate goes up even further to 6 7/8. Again, that rate spread, 6 3/8 to 6 7/8, is all based on 0 points to the borrower. So what we didn't talk about is the payments. At the 1% 6 3/8 rate, the principal and interest payment, this is based on a $500,000 loan amount, was about $3,100 a month. On the other end, at a 2.5% lender paid comp and 6 7/8 rate, the payment was $165 a month higher, almost $3,300. That's a pretty big difference. Even at the average industry of 2% lender paid comp, the monthly payment at 6 3/4 was $124 a month higher than if you're dealing with a broker who only requires 1% from their lender. And guess what, folks? In case you haven't watched the show or remember, here at MortgageWorks, a majority of the loans that we originate, we are getting a 1% lender paid comp from our lender that we deliver the loan to. That directly correlates to you, the borrower, in the form of a better rate and a better payment. If you're at the other extreme, 2.5% lender paid comp, you might not think $165 a month is a lot. But guess what? Over the life of the loan, a 30-year loan, that's over $50,000. Now, most people don't keep their loan for that long, but nonetheless, every month that goes by, you're paying that extra amount for the same $500,000 loan, and you're getting it from broker B instead of, we'll call ourselves broker A. Why would you do that? That's not rational. And that's why, if you're a borrower, I encourage you to shop around. And I include even borrowers referred to us. Feel free to shop around. We're very confident we're going to compete very, very well against any broker lender that you're going to get a rate quote from. And I encourage you to get a rate quote from anybody you're talking to about a mortgage. Get it up front. And if you're going to compare lenders or brokers, get all the quotes on the same day to make sure you're getting quotes based on the same market conditions. And Jeff, I actually ended up kind of stumbling into an example, I think, of where it can be at play.
Okay.
Late last week, after the show, I got approached by a realtor who was having trouble with another broker here in the Valley who was originating a purchase loan for a condo that's on leasehold. It's a leasehold property. It's on leased land. And that broker ended up declining the loan because of the lease. And I looked at the property. I could see there was other activity for that, where that condo was located, from some major lenders, Loan Depot and some others here locally, which was a clue to me that the leasehold should be okay. So they approached me about taking a second look at that. I went ahead and originated the loan and registered it with the lender, and it's in underwriting now, and I think we're going to get a loan approval. But as I was discussing this transaction with the borrower, I almost fell out of my chair when he happened to mention that the other broker he initially was dealing with was quoting him an interest rate of 7.5%. Now, this is a condo. It's a modestly priced condo, $285,000, 20% down, $228,000 loan amount. And by the way, folks, for a condo, If you put 20% down, you're going to get a higher rate than if you put 25% down. The sweet spot for condo pricing, keep this in mind, is 25% down, not 20. There's a 3/4 of a point add by the federal mortgage agencies for condos that you have less than 25% down, because a condo is considered a more risky property type. But that as it may, when I priced this out, when we registered the loan 2 days ago, we were we registered this loan not at 7.5, but at 6.625.
Wow.
7/8% lower than what he tells us, or told me, that this other broker was quoting him before they declined the loan. So this, I think, is a very good example of how lender paid comp, the variation from broker to broker, can be very significant in terms of the kind of rate you're going to get when you get that quote from the broker. So I just think that people need to be aware of that. And that's why I say, if you are going to be getting some quotes and you're noticing a difference in the rate between brokers, a very good question to ask is, say, okay, got your quote, got your worksheet. Can you tell me what your compensation is that this interest rate you're offering is based on? And I think that's a very good discussion to have. I think it'll put on the forefront some transparency. Any broker worth their salt should honestly answer that question and be very direct and tell you what they're going to get paid by that lender, and then ask them to explain, why that's affecting the rate the way it is.
I think a lot of times, stop me if I'm wrong, because you deal with people every day, is you do this every day, and you have a language that you speak, and it's just, I'm going to call it mortgage speak, right? And we all do that, whatever industry we're in.
Right.
We probably come in and buy a home either it's our first time, or 5 years, or 10 years. Right. And so we don't know what questions to ask. We don't really know what that means. And let's face it, there's just a little bit of paperwork that gets put in front of us. We don't even know what to ask. So right. I think by you pointing this out it's like shining a big light in a dark spot, because I didn't realize, when you start talking points and I'm like, okay, now it makes sense. If that lender, because it's one of those things, somebody's going to pay for this.
Oh, right? Yeah.
We pay for it in a higher rate. And when you, I just want to make sure I understood this right. You said the difference in your example of the $500,000 loan, 20% down, good credit, with a 1% and a 2% lender paid compensation is how much? Did you say $50,000?
Well, actually, what I said there was, if you're dealing with a 1% lender paid broker like us, where you were going to get a 6 3/8 rate at $500,000, and you're dealing with a mortgage broker who wants 2.5% lender paid comp from their lender for the $500,000 loan amount, the difference in monthly payment is $165. So over the span of a 30-year loan, it's actually about $54,000. Now, again, you can argue, yes, you may not, you probably will not keep that loan for 30 years, but gosh, what if you keep it for 4 years or 5 years or 6 years? I don't know about you, $165 a month is not that's a significant number. And why would you incur that extra monthly cost to you, the homeowner, simply because you have knowingly or not knowingly chose a broker to assist you in getting that loan, who wants to get paid a lot more for that loan than, say, we would? I think that people just need to understand that, borrowers do. And, the other thing I pointed out was the $124 a month payment difference between, say, a 1% broker lender paid comp like us and the average in the industry. Most brokers ask for 2% from their lender. That's still $124 a month difference in payment. Well, over 30 years, do the math. That's probably in the somewhere in the mid 40,000 range of higher cost by not focusing more on getting the best rate you can by working with a broker who's not going to demand from their lender to get paid as much, or demand to get paid more than we do. So,
and again, the level of work that a broker puts in, whether paid 1% or 2.5%, is there any difference?
No, a loan file is a loan file. We all compile the same pieces of paper in accordance with the underwriting guidelines of the particular program that we're offering to the borrower. We take a file folder that starts that's empty, and by the time it's done, it may be this thick. But we all do that. We're all compiling the same paper. We're all working off the same checklist, generally speaking. So yeah, what we're getting into here's a little bit of a value judgment about what's a reasonable and fair compensation to somebody like us to, put all that paper together and tell the story to the lender, because that's essentially what we're doing. What's appropriate, what's fair, what's reasonable in terms of that compensation. And I happen to think, we know the process, we know the pieces of paper, we're just putting them together in a file folder nicely and uploading it to the lender. On a $500,000 loan, if we can earn $5,000 from our lender for delivering that loan to them, I think that's fine. We can operate our business at that level. Now, some brokers have a different notion. They want to make as much money as they can on an individual loan. Now, they may do fewer loans every day, every month, every year, because they'd rather make as much as they can on each loan as they go. We're more interested in making a more modest amount, still enough to, run our business, pay our bills, etc. And then in the hope that we're going to get more loans, because what we're trying to do is establish and develop basically a database, a customer base that over time will serve us well in the future when they need to get another loan again, whether it's a refi or a purchase. So we're in a long-term view kind of a situation. I'd rather make less money per loan and then do more loans both now and into the future. So,
well, and I think we won't mention any names, but I know a while back you had a situation where someone that we both know, you were helping them out, and your rate difference was so much different than their closer friend who was helping them out that
right.
They started to question your integrity and you can't do that. In fact, I think even the other lender said that can't be done or something along that lines. How often does that happen because of the fact that, hey, you're kind of the home of the 1% lender paid compensation?
Yeah, it's funny. That did happen. And the rate differential was significant. This guy was quoting them about a 7% rate. We got him 5 7/8. And the borrower initially just didn't believe me. She didn't think I was being truthful in my worksheet I sent them. And of course, the broker she was dealing with also questioned, like, no way, no how, they can't deliver that. Well, guess what? We did. And yeah, you're right. From time to time, particularly on government loans, FHA and VA, where I think people really should focus on the fact that in most cases, you're getting offered a rate that's too high. I've seen that in the FHA VA segment of the business for years. And I've had listing agents more than once when I've asked to pre-qualify a buyer for an FHA loan, and I send out the pre-approval letter and I include the DU findings that shows the terms. And of course, my pre-approval letter, I do provide a rate, specific rate. Some lenders don't do that. And I've had listing agents call me and say, is this for real? You can do an FHA loan at, 5 3/4? And I'm like, yes. I mean, look, I've been doing this for a long time. I'm not going to be in the business of giving you something that's not real. Why would I do that? That's not rational, for one. I want to get the loan, but I'm not going to lie about the rate just to get the loan. That's a fool's game. I'm just not going to do that. So yeah, we do run into that from time to time.
Well, I just wanted to clear that up because I thought, a lot of people, that's what they're asking is, hey, what is my rate? What is my payment every month? And when you $124 or 160, was it
165? Yeah.
Yeah, that's a significant amount that, if you only had to pay it once, it's not a big deal. But if you have to pay it month after month, and let's face it, people are holding on to their loans a little longer in this current market. It just means it adds up to a bigger, compensation that you didn't have to pay for. So I really appreciate that. Make sure to get a hold of Art for more information, and he'll get that. But let's talk about something else that is kind of out there in the marketplace that, is kind of crazy because you have warned us about. I remember early on when you first started your show, you told us to beware of this stuff. And it seems like every day there's some kind of wild headline. So this is one that popped up. And I just want to, are the reports we read true or false? And is it hype or reality? And, when it comes to, and as I say on here, who should we believe? Like, who should I believe is if I read this and it says, interest rates plummet, now you should buy. And I look at them going, listen, I'm looking at the 10-year. Now you've got me hooked. I'm looking at 5 times a day and I see this stability. I'm like, where's the plunge?
Right.
And so, yeah, I thought if you would, I'd like to talk a little bit more about that, and specifically in an area that inside the mind of retirees. And let's talk about that a little bit, because I want to talk about a little research that Merrill Lynch did, and I'll bring it up on the screen here. It said research from Merrill Lynch shows that 64% of retirees are considered downsizing, and 41% added they intended to downsize into their next move. What are the implications of this for the real estate, or excuse me, for the real estate and mortgage market? And this, of course, this had a disastrous headline on it that, you just got to check it out. But I thought, let's see what Art says about this.
Yeah, I mean, this is another example of beware the headlines. So yeah, let's talk about this, and then we'll talk about the refi thing, because that's where the headlines really get kind of silly. With this, first of all, what I would say is this research from Merrill Lynch is not necessarily new news, and what I mean by that is, it's fairly normal that homeowners, as they get into their senior years, oftentimes are empty nesters at that point. They may have a home that's no longer fits their needs, in the sense that it's maybe too big. It's got lots of bedrooms, and the maintenance costs are an issue, and so forth. Particularly as you get into your senior years, and maybe your income starts to diminish. So this is really talking about downsizing, buying down in value and so forth. That's not a new phenomenon. That has been around for years. I think what the Merrill Lynch research shows is that phenomenon is increasing, that there's more focus now on downsizing than ever before. And the percentages, both for those who are considering it and those who are saying they're going to do that as their next move, is higher than it used to be. So first understand that. But what's happening now is we've got factors that are really putting some pressure on senior homeowners, such as cost of living, inflation, too much consumer debt. So you have to consider that those are factors now that are having a bigger effect on senior homeowners than it has in the past. Implications to the markets, real estate. First of all, if you're a real estate agent, and I think a lot of good agents already do this, particularly in our valley here. We do have an older demographic in some of our cities. Obviously, this is a good target to focus on and getting more listings of senior homeowners who are looking to sell and downsize. And of course, really what that can provide is two opportunities: opportunity to list the current home, and then once that's sold, an opportunity to represent them as a buyer to find that other home that they're going to downsize into, assuming that they do want to purchase another smaller, less value home. So that's the obvious opportunity for a real estate agent. In the mortgage market, there's a few things in terms of opportunity. One is, for some senior homeowners, it may not be a case where they need to downsize, but they may need to have access to the equity to help manage the expense of continuing to own that home, because after all, a lot of senior homeowners want to stay in their home long term. So the obvious implication for the mortgage market is, we have refinance opportunities. In some cases, a cash out refinance will make some sense if you have a low existing first mortgage, or even better, no mortgage at all. And even if you have a low first mortgage, low rate first mortgage, you're 2.5%, 3%. If the loan amount's pretty modest and you need a pretty sizable amount of cash out, it may make sense to refinance into a new first mortgage, give up that 3% rate, get a 6 3/8, 6.5% rate, because when you do the blended rate analysis, your current balance on your existing loan and the amount of cash out you need for the new loan, there's a delta there where it could end up being costing you more to get that equity through, say, a second mortgage that has a higher rate, versus just refinancing the first and getting that cash out. So that's one opportunity for the mortgage market. The other, though, is the equity lending. We have various options for that senior homeowner if they're thinking about downsizing, but maybe they'd rather really keep that home, but they need access to more equity, more cash to help them keep that home. So where we can help there is typical equity lending, fixed rate second mortgages. The 20-year fixed rate is a very good product right now, very well priced in terms of rate. HELOCs, obviously, home equity lines of credit. But more in particular for a senior homeowner, some other options for getting equity from that home in order to keep it. One, of course, is the obvious, the HECM, the home equity conversion mortgage, the FHA reverse mortgage. That's an obvious way to help a senior homeowner avoid having to sell and downsize. It could help them keep that home if they have an existing mortgage, pay it off, get access to additional equity so that they can use those funds to help maintain ownership of that home so they don't have to move. And then the other big product that we do a lot of that helps in these kind of situations, and I think can help a homeowner avoid downsizing, is the Home Safe Second. That is a reverse mortgage second mortgage product, and this is very good product for somebody who's a senior homeowner. They have a existing first mortgage. It's a low balance, even if it's a low rate. The Home Safe Second will give the opportunity to the senior homeowner to get additional equity out of the home, additional cash, and then use that for whatever their needs are, whether it's consolidating debt, maybe modifying their home for their senior years in terms of accessibility and so forth. So it's a very good option as an alternative to a senior homeowner who is facing, I need to downsize because I can't handle what I have now. The Home Safe Second could help them avoid having to do that and do what I think ultimately a lot of senior homeowners would like to do, which is to stay in the home for the duration. And the good thing about the Home Safe Second is it's a reverse mortgage-like product. You don't have to make payments on that loan unless you want to. And that can be a very good factor for those senior homeowners. If you have some cash assets, you could make payments at any time for any amount as you wish, but you have the option not to. And at certain times, that may be very convenient to be able to skip making payments on that second. Plus the fact the Home Safe Second for that senior homeowner is in most cases much easier to qualify for than a traditional HELOC or second mortgage in terms of debt ratio requirements, in terms of credit score requirements in particular. So keep that in mind if you're a senior homeowner thinking about downsizing. There are some alternatives to help you avoid that. But if you have to, for you realtors out there, this is a market to definitely target. You could get a listing and a sale from that same customer. So keep that in mind because I think this phenomenon is going to be even greater than it was before.
I think this ties right into what you talked about the last few weeks, and that's 71% of retirees and senior homeowners are saying, hey, they're worried about running out of money before they run out of life. And exactly. This is a great way to do that. So the Home Safe Second. Exactly. I like that idea about don't have to make the payments unless they want to. And,
right.
That doesn't have to be consistent, does it? They can make lump payments. They could do it once every now and then, once a quarter. Is that true?
It's absolutely true. And that's what's so great about the Home Safe Second is because of the fact that it has that flexibility. You're in control. If you're worried about that loan balance going higher because you're not making payments, you've got the assets to address that, make some payments, make it monthly, make it quarterly, make it twice a year, once a year. So you have that flexibility. And that's why it's a really good tool to use. If you're that senior homeowner, you need that access. Maybe you got turned down for a traditional HELOC. This is a way to get it done and help you stay in the home if that's what you want to do.
But you had mentioned, I want to bring this up real quick before we go to the next topic. And you had mentioned that having that Home Safe Second, I believe, as a backup to let's say your normal retirement. And I think about this week as volatile as the stock market has been and how it may have impacted some people's portfolio and maybe their cash flow. Am I on the right track? Can you bring that up again just real quick?
You are. What you're referring to is there's a concept called sequence of returns risk. And so there are senior homeowners out there. They have a lot of equity. Maybe their home is free and clear or very small mortgage balance, and they've got some decent amount of funds invested in the market, oftentimes through something like an IRA and so forth. And they may have set up a recurring monthly distribution from that investment account, including retirement IRA accounts and so forth, for money to basically live on. The reverse mortgage can be a great tool to manage this sequence of returns risk, because here's the problem: you've got an IRA account with maybe it's $1 million, and you're taking out pick the number, $5,000 a month for just money to live on. Well, an IRA account that's fully invested in the market in terms of stocks, bonds, mutual funds, and so forth, the way this last week or two has been, they've lost some money, right? and which can be a concern. So if they had thought of getting a reverse mortgage on their home and have that available, typically you would do that by having a line of credit set up, then this sequence of returns risk provides that homeowner the opportunity, if that IRA account's dropping in value because the market's selling off, you can temporarily halt your distributions from that account and instead use the line of credit from your reverse mortgage to cover that 5,000 a month you had been drawing. That way you're still getting the access to the funds you need to live on, but at the same time you're not diminishing your investment account, your IRA account, in a declining market. And that way you can kind of do that and go back and forth to help manage your investment funds, and then go back and draw on those later when the market returns, because as we know, it almost always does.
I think that's a brilliant idea, because I've heard that just recently in the last week playing pickleball, because it tends to be a little older community. Right. And they're talking about, well, because of the market, we've kind of pumped the brakes a bit. We're not going to go do that trip right now. We're going to wait for some recovery. And this says, hey, you know what? Enjoy your life. That keeps your lifestyle steady. And when one goes down, the other one goes up, and it's kind of nice to have that set up.
Yeah, that's a great example of how this can work. Yeah.
Thank you very much. Well, this next one now, this one is a little bit of a headliner that we both kind of shake our head at: the surge in mortgage applications. First of all, address that, the surge of mortgage applications. That really true?
Well, yeah. One of my frustrations with the media in general, and of course we talk constantly about beware of the headlines, and one of my frustrations about the media is their tendency to use some pretty strong adjectives, we'll say, in some of their headlines. And of course, we're seeing that now. There was a news article, Jeff, I think you saw it, where, most recently, it was earlier this week, where according to the MBA, which, by the way, everyone, MBA is Mortgage Bankers Association, so they know something about mortgage rates, obviously. And this article had a headline about, interest rates, mortgage rates have plummeted, and that's triggered a surge in mortgage applications. And so, yeah, the question is that really true? Well, yes and no. First of all, I went back and looked at the MBA, and then, by the way, this is a weekly survey they do. They do this. They publish this every week. So I went back and looked for the previous week. Well, of course, the previous week, the headline was mortgage applications have dropped, because of continued high rates. So there's obviously a little inconsistency in the headlines just from week to week. But for better perspective on, rates plummeting and mortgage applications surging, first thing I'll tell you is, everyone remember last September, the bond yield was 3.6, and we were down to like 5.5 on a conforming 30-year fixed. Unfortunately, that didn't last long enough, literally a week or two. So the industry had suddenly braced itself for, we're going to have this big refi boom. Well, it dissipated almost immediately after it started, because when the Fed lowered the Fed funds rate 0.5%, bond yields got worse, and that mid-5 interest rate disappeared in no time. So keep that in mind. So the point is, yeah, mortgage rates have fallen. Would I say plummeted? No, because they haven't gotten back down to September of last year. We're still 0.5% higher than we were just 5-6 months ago. So to suggest rates have plummeted, well, yeah, maybe over the last month or so. Plummeted is a relative term. But here's the other thing I looked at. Overall, when you look at the MBA, I went to their website and looked at this index. And again, they do it weekly. Back in early 2020, March of 2020, the index was at 1,172. Now, that's just an index number that measures the amount of application activity. Well, February 17th, which is about, it's last month, that index number was 230.
Goodness.
Well, if you do the math, 230 index value, mid-February, 1,172 March of 20. That means current application volume is it's less than 20% of what it was in early 2020, 5 years ago. Less than 20%. So when you start seeing these adjectives about surge and rates plummeting, it's all relative, and it's really in reference to more recent periods. But even then, I would say these adjectives are overdoing it. It's creating a false sense of just how much better things are. And again, we're still worse than we were 5 months ago. Even if you take January of 2021, the index had fallen to 946, and that's still 24% lower. We're still at 24% of that number from January of 21. So the point of it is the current application level is literally only about 20 to 25% of what it was 4 or 5 years ago. So that tells you how depressed the mortgage industry overall is compared to where it was. Now, that being said, I will say, and I'll let everybody know, again, remember, Fannie Mae is saying mortgage rates are going to be at 6.6 at the end of the year. They'll get to 6.5 at the end of 26. So those of you who are homeowners and you've got a lot of equity, if you've been putting off a refi because you think rates are too high and you're waiting for them to come down, I don't think you should do that. And we are seeing more refi activity. Some folks have finally gotten to the point where they're going to just get buried with consumer debt. So some of those kind of refis are happening now. They're giving up that low rate because they need to get rid of that other high rate stuff. Now, of course, that comes with it discipline to not, re-incur that high rate stuff, because it's usually short-term credit card borrowing. So you really have to have a change in behavior if you're going to take that step. But there's a lot of other refi opportunities that are popping up, and we are seeing that in increased activity. I'm doing a refinance for somebody who we had to get them a non-QM loan because they had just become newly self-employed about 15 months ago. And at the time, the best rate we could get them was 8.5. Now we can get them a much better rate because more time under their belt, self-employed, and we can get closer to a conforming rate. I've got another transaction, a refi, for somebody who bought a brand new home about a year ago because she had started a new job that was a good amount of her compensation was commission only. She ended up having to get a private money loan to get that purchase completed. Well, now we're working with her to get her a refinance where we can give her a conforming loan rate that's going to save her a substantial amount of money per month. And of course, then you have the other kind of refis that are happening, such as somebody's getting divorced, unfortunately. Oftentimes that will trigger a need to refinance the property if one of the spouses want to keep it. And then the other thing that we see a lot of, and we're seeing more of, is somebody inherits a home, a family inherits a home. And maybe some of the family wants to keep the home, but others don't. You can do a refinance to buy out the ownership interest of one of the other people, and so that home could be kept. So the point of it is, yes, this is an exaggeration, but I think we've, as I've said earlier, mortgage rates have stabilized to the point where I think more and more homeowners are realizing no point waiting any further. Take advantage of the rates where they're at now. In a lot of cases, a refinance will make sense depending on what you're going to use that money for. And we can help you with that. So I would encourage anybody, if you're contemplating that, you're on the fence, call me. Let's have a conversation, and I'll help you decide if it makes sense or not. I will not hesitate to tell you, don't do this if it's not in your best interest. So just keep that in mind.
Well, I just want to pull something up because you said something about, what what Fannie Mae is forecasting for the interest rates, and I just always, we haven't spoken about it in a while. I know we probably beat on it a lot, but I wanted to talk about this, and that's these buy downs, the 3-2-1 and the 2-1 buy down. I mean, wouldn't that, Art, make so much sense if somebody said, hey, if I can get a 3.75% now, and it goes up 1% every year, but now you've got a 3 or 4, or you have a 4-year window, do you not?
Well, basically you do, or at least a 3-year window. Yeah, that's the whole point here. For the home buyer or the potential home buyer on the fence, I think when you hear that Fannie Mae says 6.6 end of this year, 6.5 end of next year, why would you wait any longer? Because what's happening by waiting? We've talked about it before. Home values keep going up. So if you hadn't kept waiting and you bought earlier, you already would have some increased equity if you had purchased earlier. I would argue that given the latest forecast, if we're going to be at these levels for a couple of years and you've been wanting to buy a home, you may need to buy a home, I don't think it's in your interest to wait any longer. Now, you may be dealing with the fact that you don't like the rate levels and the payment levels. We do have to determine that you qualify for those levels. But if you do, use a tool like the buy down to get you payment relief for at least 2 up to 3 years. And that gives you that window to where when rates do fall, and it looks like now, according to Fannie Mae, it may not be till 27. At least in the meantime, you get a much better rate, much better payment, and you're basically positioning yourself to then look at a refi on that note rate in 2 to 3 years.
Well, it just makes so much sense. And one last thing, we were having dinner with some friends the other night, and they introduced it to somebody new, and it was in San Diego, and this gentleman was there. He owns a large brokerage or a large real estate firm in Michigan, and he was there for a conference. And he started speaking. I thought, is this Art talking? Because he was talking about the fact of because I said, I just curiously asked, I couldn't help it. I said, hey, how is the real estate market? Kind of being naive. And he says, well, this, that, and he said, but people who think they're saving money by renting, he said, and he gave us the statistic about 40 times more wealthy by being a homeowner. And, I think about instances just not long ago, let's say 6 or 8 months ago, and you're talking about somebody and they're waiting, thinking they've lost all that potential equity and it's only made the gap wider for them. And they can take advantage of it with a 3-2-1 buy down, which what I see, stop me if I'm wrong, because I don't want to misquote anything, is I'm starting to see a lot more listings come on the market, which means the supply demand, I think you call it Econ 101, is if there's more supply and less demand, what do people tend to do? Be more negotiating. And that's your 3-2-1 buy down fuel, isn't it?
It is exactly right. Now, I'm hearing from agents that sellers are still being pretty resistant to adjusting their price. They just think their home is worth a lot more than maybe it is. But nonetheless, there are opportunities. I mean, we're getting ready to close a purchase loan with an FHA loan for property in Cathedral City. I think I told the story. It was $574 list price. They were going to offer $550. I said, no. Try offering $574 and ask for a seller credit to pay for a 3-2-1 buy down. They tried it. The buyer liked it. His agent liked it. They tried it. Now, what did happen? The seller responded, didn't agree fully. They said, yeah, we'll do the seller credit for your 3-2-1 buy down. Well, we don't want $574. You got to give us $580. Well, guess what? That's still a good outcome. For $6,000 in higher price, which is $36 a month in payment, this buyer was able to get a 3-2-1 buy down off of an FHA rate that was already in the 5s. And so guess what? His first year interest rate's 3 3/4.
That's fantastic. Yeah, I could talk about this forever. I know you're busy, but again, great show today. And I really appreciate that. If you need to get a hold of Art, here's his information. 760-969-5023 is his office. His cell phone, I haven't said it in a while. His bat phone will light up when you call him at 714-612-9035. And of course, you can always go to the website, mwloan.com, where you can see the information we talked about before, the rates, and also more about what is the mortgage loan. And of course, you can email Art at Art, very easy, mwloan.com. Art, I want to thank you again. I'll step out and let you finish up. And great show. Thank you.
Thanks, Joe. Thanks, Jeff. Well, thank you, everyone, for watching and listening to this week's Mortgage Minute. By the way, in my comment there about the buy down, that FHA buyer, actually their first year rate is 2 3/4, not 3 3/4. It's 3% off of a 5 3/4 note rate. With that, again, thank you for watching and listening to this week's Mortgage Minute. Please have a great weekend. I look forward to seeing you next week on our next edition of the Mortgage Minute. So in the meantime, my name is Art Alvarez at MortgageWorks, where we have the answers and they're on the house. So long. Take care.